let's wait for it there. It's going to do its thing. And then we're going to wait about 10 or 20 seconds to make sure it's populating here. Webcast admin. Cool. That's good. That's fine. You want to hit F5 on this. There. Back. There it is. Okay. So now scroll down. Hit the first one, which is hello. See that? Just hit submit. Are you on mute?
How's the conference going so far?
Good afternoon, everybody, and thank you for joining the session. Buff is in the room. We are ready for an on-time start at 3:20 p.m. Eastern, so just sit tight and we will get started momentarily. Thanks for joining the session with us. Good afternoon, everybody, and thank you for joining the session. Buff, our speaker, is in the room. We are ready for an on-time start, so just sit tight for about 2 minutes, and we're going to get started at 3:20 p.m. Eastern. We are going for 30 minutes, so just sit tight, and thank you for joining the session. We'll be right back with you. Good afternoon, everybody, and welcome to the session. A couple of bits of housekeeping. We're going to jump right into Buff's presentation. First and foremost, we want to thank everybody who participates in the virtual shows and, of course, the Money Show live events. We appreciate your feedback, so keep that coming. Secondly, as you're watching this in the player, to the right of Buff's player, you'll see a chat box. You can send over some questions. Time permitting, we may get to a couple if Buff has time, but definitely send those questions over. Any technical questions, questions for Buff directly, and send those over. And again, time permitting, we'll get to it. It's with great pleasure, though, I am welcoming back to Money Show Buff Dormeyer. He is the Chief Technical Analyst of Kingsview Partners. Buff provides 3 important roles to Kingsview clientele: that of a financial advisor, analyst, and portfolio manager. Armed with proprietary indicators and investment programs, Buff dynamically advises financial advisors, RIAs, as well as affluent and institutional clientele on strategies to help meet their specific investment objectives in uncertain investing climates. Buff, it's great to have you back at Money Show. The floor is now yours, sir.
All right. Well, thank you. So today we're going to lay out how to build a multi-layer portfolio defense by combining protective passive defined outcome ETFs, which lower volatility but are lacking in alpha, with volume factor tactical asset allocation. Together, these encourage portfolios to maintain a low risk profile while enhancing alpha. As Joe already mentioned, I'm Buff Dormeyer, Chief Technical Analyst of Kingsview Asset Management. I'm also an index specialist with Monarch Funds ETFs, and I'm also the developer of these tactical asset allocation models, also known as OASIS, Outcome Anchored Symbiotic Investment Strategies. So-called modern portfolio theory recognizes the benefits of asset allocation correlations as well as diversification. Is now 75 years old, but we are now living in a postmodern asset allocation world that recognizes the value of behavioral finance, taking into account styles, factors, intermarket, and as well as intermarket analysis. So what if your asset allocation went beyond correlations towards building symbiotic relationships by combining passive and protective defined outcome ETFs with active and tactical strategies? To review, a symbiotic relationship is where different species cooperate, support, and mutually benefit from one another's. Likewise, by combining this volume factor tactical with strategies such as buffers and floor, creates a multi-layer defense, creating symbiotic relationships within your portfolio's ecosystem. So tactical management begins with a strong defense. And what do they say about defense? Defense wins championships by keeping you continually in the game. Investors need to feel they're always in the game and the right to prioritize a risk management approach. We call this industry the securities business, right? We used to take our security from our sheep and our goats, our lands, our fences, our walls, and our gates. But today, we take security in our personal balance sheet. A financial advisor's fiduciary duty is to provide that financial security by protecting and ensuring their clients' lifestyles. Yet, most think only in terms of near-term performance, as that is often how they're judged and evaluated by their clients. Capital is precious, and investors understand this all too well. Drawdown is the universal statistics all investors intuitively understand, and they're right to expect their investment managers to have a game plan to protect them, yet most don't. Most are expecting their clients just to grin and bear it and just hope it all works out. So part one of our risk management plan is to respect the laws of multiplication and reverse compounding. So if you lose 10%, you need only 11% back to get back to even. But if you lose 20, you now need 25. If you lose 35, you need 54. And if you lose half your money, you're going to have to double it to get back to even. Okay, so what's our game plan? And we're going to begin our game plan with a product called buffers. Defined outcome ETFs are ETFs. They're not market-linked CDs. They're not structured products. They're not indexed annuities. Defined outcome ETFs are ETFs, but they have an option overlay on a passive index, and that provides protection of a sophisticated option overlay without the tax implications. So let's start with shallow buffers. Okay, this is Buff. Yes, my namesake. Buff is a shallow buffer. It provides a 15% annual buffer of ladder protection against the first 15% of loss. Thus, if the S&P falls 20%, the buffer protects the first 15 for only a 5% loss. The give up for this benefit is a ceiling on the upside. A 15% buffer may have a 16% cap, whereas a 10% buffer may have a 19% cap. Deep buffers are typically utilized as bond alternatives. So here is an example of BALT. BALT is a deep buffer. It provides a 20% buffer every quarter. And since its creation, the S&P has only had 5 down quarters of more than 20%. The most recent was in 2008. So BALT's quarterly return cap is low. It's only 2 or 3% a quarter, providing BALT a return profile that looks similar to interest rates. Now, since we're using it as a bond alternative, let's go back to 2022, when bonds were significantly down, 16% or more, due to rising inflation and rising rates. BALT, as a bond alternative, squeaked out a small gain, as none of the quarters in 2022 lost more than 20%, but the fourth quarter was positive. Of defined outcome ETFs, floors are my absolute favorite vehicle. Floors are the inverse of buffers. They do not protect against the first X% of loss, but everything below that. Floors are akin to a high deductible health insurance plan for your portfolio. You pay a premium for the insurance that is typically 20% of the upside capture, meaning if the passive index is, say, the S&P 500, you'll get 80% of the upside participation. The key is there's no cap. This encourages compounding. So if the market has a small loss of less than 10, you will have to pay the deductible, and that's suffering the full loss. However, if it's anything greater than that 10%, it's covered by the synthetic floor. So if the market goes, S&P goes down 10% for the year, you'll lose 10. But if it goes down 50, your max loss is only 10. In a secular bear market, let's go back to the last lost decade. By keeping the losses low, the floor strategy cut down the break-even time in half. So when a catastrophic market has an event, you're going to pay your 10% deductible, and that's it. Since 2000, you can see here in this slide, since 2006, the S&P has returned approximately about 9.5%. And the floor strategy is very close to that. It's 9%, but it had significantly less risk and drawdown, providing the floor strategy with a much higher risk-adjusted rate of return. Now let's switch gears from defined outcome that use option overlays to tactical risk overlays. And the most common of these active risk management tactics to avoid bear markets is just following the market's trend. And when the trend is up, you want to stay long. When the trend is down, you want to get out. Trend following systems work because they keep the drawdowns low. So here, illustrated here, are 5 trend following systems utilizing moving averages. The most common of these is this 200-day. Why? Because the turnover is the less, and making it the most practical. Over time, you can see here that all of these strategies have beaten buy and hold, and they've all done it with significantly less risk. Okay. Now, however, these trend following systems work, but they have significant drawbacks. Okay. The first is that price trends, although they've been effective at avoiding the bear markets, they're also notorious for whipsaws along the way. And 2, they almost always, by definition, miss the initial run-up, which is often the strongest point of investment return. So what we're going to do here now is we're going to solve these problems with the volume factor risk management overlay, and we're going to show you how that comes into play to solve the problems. And to illustrate this, let's look at what have you done for me lately. The market following the market trends has worked historically, but look what's happened probably during most everyone's in this room's investment careers. Since 2000, the S&P without dividends returned 6.3%. But following the 200-day moving average, only returned 4.2. Its risk was much lower, but it's still not enough to overcome and have a higher Sharpe ratio. So what we're going to do is we're going to use the volume factor to solve these inherent problems, but with utilizing price as the market's discounting mechanism. So think of volume analysis like this. You are now a pilot of an airplane, and you want that plane to go higher. So you change the trajectory of the plane by pulling up on the yoke, aiming it higher. However, if you do that, and that's all you do, what direction do you think that plane is going to go? That plane is going to go down because you didn't give it more throttle. You didn't give it more thrust. So it's the plane is likely to stall. So what is the fuel of the stock market? The fuel of the stock market is capital. It takes more and more people willing to provide more and more capital at ever increasing prices to keep the proverbial plane ascending. Okay, if the market's moving higher with fewer and fewer capital flows, the market lacks the fuel to continue and may likely stall. Thus, our solution to replacing lagging price data is using capital flows. Okay, so there's two problems with using volume data. The first problem is one, the data feed. Okay, and two is the way the data is compiled. So problem with number one, the data feed. Okay, just pull up a quote on the S&P 500. Okay, now you see the price, and now look at the volume. How much of that volume do you think is attributed by, say, a predominant group like the Mag 7? You think it's 30%? Think it's 10%? The number is actually on your quote is probably zero. Why is that? Because volume data is compiled on the exchanges, and the exchanges compile volume not on indexes, but the exchange, not by index data, by exchange data. So thus, when you pull a quote up on the S&P 500, most data services you're going to find is not the S&P 500, but it's actually going to be the volume of the New York Stock Exchange, Tape A. And how many of the Mag 7 stocks trade on the New York Stock Exchange? Well, none of them do. So you're not getting any of the volume in your quote. Now, if you think that first problem is an issue, the second one is actually significantly worse and more difficult to solve. So that is how the data is compiled. So to explain how this works, let me walk you through an example. In 2007, Citigroup was the fifth largest S&P 500 component. Its average volume was less than 1%, but what happened to Citigroup during the global financial crisis in 2008, 2009? Well, its stock fell over 90%. It went from being a 5% weighting in the S&P to less than 1/10 of 1%. But what do you think happened to Citigroup's volume over that same period of time? It went down, it went up over 1,000%. And before it had its reverse split, Citigroup actually accounted for north of 25 to 35% of the daily volume tallies, even though as a penny stock, it had virtually no attribution to the index. So here's the bottom line. Because volume is tallied and price indexes are weighted, small price stocks are heavily overweighted, and large cap stocks are drastically underweighted in the volume tallies. The end result is depicted here in the slide. If you're using traditional volume data in your analysis, as our lady here has just discovered, you too are on a date with the penny ones. So remember this slide? Now, what if we swap the 200-day price trend to an equivalent using a capital weighted volume trend? Okay, so this is my proprietary capital weighted volume designed to repair all these issues. Okay, as opposed to following price or defective volume tallies, we will follow the accumulated trends of this capital weighted volume. And when we weight volume in accordance to its weighting within the price index, it harmonizes the relationship between price and volume, unveiling the market's true discounting mechanism. So since 2000, by following the trend of capital weighted volume as opposed to underperforming the market by over 2%, capital weighted volume outperforms by nearly 2%. Improving buy and hold from 6.2 to 8%, but at the same time, look what it does with the risk. It maintains the reduced volatility and drawdown, resulting in a much higher over a doubling the Sharpe ratio compared to buy and hold. Here's another one. Here's capital weighted dollar volume or capital flows. As opposed to looking at just the volume, this is capital weighted dollar volume tracks the amount of money or capital flowing out of the market. The results look about the same, but the signals are a bit different. Okay, so let's take a look at the most recent trend failure. Okay, this is the tariff tantrum. The S&P here is in purple, and the blue line here is Pacer. It's a tactical billion-dollar strategy that follows the 200-day moving average. And in orange is the volume factor global strategy, utilizing S&P 500's capital weighted volume and capital weighted capital flows as its risk overlay. So in this most recent correction, our volume factor strategy began defensive positioning way back on March 11th and was 100% cash by March 25th. So it missed the entire tariff tantrum sell-off, whereas the Pacer trend pilot following the 200-day didn't sell completely out until April the 8th, the day before April 9th bottom. So why did theirs fail and the volume factor excel? It's because volume leads price, but moreover, volume acts as a polygraph by either confirming or contradicting the price trend. Price is just the effect. Volume is the cause. Volume is designed not only to lead price for quicker responsiveness, but simultaneously improve accuracy for more reliable indications. Another reason trend systems fail is that by definition, they can't re-enter the market until it's already moved up. So for this reason, we employ volume factor special teams. Special teams is the transition from defense quickly back to offense. And this is particularly important because the most powerful segment of a bull market is generally birth. Okay, but yet trend systems can't catch the bottom. They can only re-enter after generally an explosive move to the upside has already occurred. So to illustrate how volume special teams works, think about this. Do you know anyone who's always right? No, but you probably do know several people that have a knack of doing the wrong thing at precisely the wrong time. There's a symbol to track these people who buy on greed and the fear of missing out and then sell on their own fear and panic. That ticker is SPIDER, SPY. It represents the retail trade. SPIDER follows the S&P 500 to the T on price, but what we're interested in is SPIDER's volume. During bear market bottoms, SPIDER's volume blows up exponentially. 25, 50, 100%, 200% or more. And what we do is we look at an asymmetry between the SPIDER's price trend and its volume. And when it becomes disproportionate, according to our volume price confirmation indicator, that's the setup that tells us that the bottom end is forming and the weak-handed investors are selling out. Okay, that's the trigger. Okay, that's the setup, and the trigger is when this VPCI turns back up. Okay, and that tells us the retail trade is now completely capitulated. It's often the darkest point before the dawn. Who else bought on March 9th, 2009? I keep some of those purchases in my portfolio just as kind of trophies. Okay. Now, let's go look a little more recent. What about the pandemic? The V bottom this time actually occurred 2 days earlier on March 19th of the actual low. Okay. By the way, this signal was called out in our volume analysis weekly commentary. In contrast, here's the 200-day moving average, PTLC, which follows the 200-day moving average. It again sold out at the very low, only to miss the massive rebound rally. Okay, so, and there's another capitulation bottom. Call this the VPCI W bottom. It's basically two VPCI V bottoms in a 60-day window. The first one wasn't deep enough, so we take the second one. Okay, that last signaled on September 30th, which was the lowest close of 2022. All these bottoming signals, the 2020, the 2022, and what I'm going to talk about next, the 2025, are all called out on my volume analysis flash update weekly commentaries. At the end, I'll show you how to get those for free. Our most recent V bottom was 2 days late, arriving on April the 11th. The bottom was actually April 9th. But by the end of the month, our volume factor strategy was positive, whereas the market was still down over 6%, and the following the 200-day moving average was still down 10. So in this way, the volume factor utilizes the institutional flow data to capitalize on market trends and uses retail volume sentiment to identify capitulation points. Thus, it follows the big money to know where to invest and when to exit, and then it uses retail volume sentiment data to identify when to get back in. So far we discussed defined outcome ETFs and the volume factor tactical risk overlay. Now what we're going to do is we're going to combine these. So we're going to show how to incorporate the volume factor with buffers and floors. Now, some ecosystems may possess what is known as a keystone species. This keystone species has a disproportionate symbiotic role in maintaining the balance and the health of their habitat. For example, a beaver is the only species that creates its own habitat by damming up the water, creating the wetlands that all the other species of wildlife benefit. So from our same perspective, in our portfolio ecosystem, the volume factor plays an inordinate role in both the bullish and the bearish market environments. Okay, so in our ecosystems, the volume factor acts as the keystone species, maintaining the balance of the portfolio by gauging the health of the market and adjusting the asset allocation accordingly. So correlations are important because they lower risk. But today, everything seems to be positively correlated, right? So what are we going to do? We're going to utilize these symbiotic relationships between buffers and floors and the volume factor risk overlay to accomplish the same goal. So to illustrate this, let's talk about two other creatures that are in a race. You know the race. It's the tortoise versus the hare. The key to any risk management strategy is to keep the volatility low and the drawdown low as well. Here we have two investors, the tortoise and the hare, both average a 1% return. The hare does it on high volatility. It has a 10% monthly return followed by an 8% monthly return. The tortoise achieves the same 1% monthly return, but on lower volatility, a 4% gain versus 2% loss. And we know who wins the race. The hare finishes with 115, the tortoise with 125. Why is that? Low drawdowns, low volatility, not only deliver a more comfortable ride, keeping investors in the game, but simultaneously creates greater returns over time. So but most importantly, in the case of financial planning, lower drawdowns deliver a higher probability of producing a successful investment outcome. So here are some of the TAM models that we formed to create symbiotic relationships. Okay, in a bull market, defined outcome ETFs, they can't produce alpha, but when combined with this volume factor, they can lower the risk. The lower risk profile is maintained, but with alpha generation. So here's just the growth of 100,000 using the aggressive model versus 90-10. Here are some returns of the TAM portfolios versus the benchmark. Just key days look at 2008 and then 2022. Don't look at 2025. It's out of date. We can also look at the index volume. The index data of all the models, and you can see here that using the aggressive model, you can see how that's done. This is where the rubber meets the road, though. Most importantly, we need to know is where is the money moving? And the money is moving from the accumulation phase to the distribution phase. Okay, and the distribution phase is the most important piece, because financial advisors, this should be focusing on the distribution phase should be mandatory, because it's important for them to retain their clients, differentiate their practice, and enjoy their client reviews as opposed to dreading them. And that's all about keeping the drawdown low. So on the left here, we see how much income is withdrawn with X% plus inflation. Okay, so go through these real quick. TAM aggressive model versus passive from 2007 to Q1 2025, using a 3% produced $1 million in TAM versus less than 900 in the 90-10. The 5% 1.4 versus 1.2, and then the 7% 1.6 versus 1.335. Now that's the income piece. Now let's go over here and look at the principal piece. So if you're going to take let's just look at this one here, 70K distribution growing with inflation. Okay, the passive benchmark lost 1.4%, whereas the TAM aggressive model was up 3.3. Okay, so the ending value was 772. Versus almost 1.8. So the TAM model finishes almost more double the passive benchmark, but it also generated over here 15% more income. So which experience do you want to have? Okay, I also can build some of these TAM custom models. So this is a portfolio someone sent me, and then we made some adjustments to create their own TAM blend. Okay, and this is like the before, and this is the after. Okay, so you can, if you'd like, you can send me your copy of your portfolio, and I'll create for you your own TAM model. So here's a big question: are you open to upgrading to the next level of modern asset allocation? Think about this. In 1939, Boeing introduced the Stratliner, which revolutionized air travel via cabin pressure. Prior to cabin pressurization, flying was noisy, it was uncomfortable, it was cold, turbulent. But then came the breakthrough of cabin pressure, allowing aircraft to fly higher than the storms, above the turbulence, where the air is calmer. Investors or passengers, whether you're an individual, an advisor, or an institution, all crave stability and predictability, especially when navigating uncertain skies. So the symbiotic approach of marrying protective passive with volume factor active and tactical balance brings balance, and it brings opportunity to markets, and through providing multiple layers of risk management protection during market drawdowns. So altogether, the OASIS or TAM framework is designed to achieve this by, one, using the volume factor risk overlays to gauge the investment climate to fly higher and faster, while avoiding the storms. Defined outcome ETF provides stability for the experience, and combined together, they produced goals-based outcomes that align with investors' often irrational experiences and their poor behavioral tolerances, providing investors with a smoother path and a more enjoyable ride. Okay, now if this is of interest to you, I'm offering these free resources for your own study. So we got white papers. If you want those, you can email me at info@buffdormeyer.com. I have a new book out, just about a year old now, The Volume Factor. You can send me an email and I'll send you a digital copy or a coupon code for a digital copy of my most recent book, The Volume Factor. And then you can also subscribe to my volume analysis flash updates. You can do that here at info@buffdormeyer.com. So I appreciate everyone's time today. Do I have Joe? Do I have any questions?
We don't have any time, but Eddie was asking what the expense ratio is for SFLR. I researched it. It looks like 0.89% or just under 1%. Is that correct?
That sounds about right.
Okay.
I wouldn't worry about expense ratios in these products. It's about what they do, what they deliver, and they deliver an experience that you can't get with the passive, and you can't build at a cheaper cost on your own.
Great
And
point.
and you can't get the tax benefits either. So
Good point. Well, we appreciate great presentation. We had a good crowd in the room. Thank you, folks, for joining us. Buff, we appreciate you coming back to Money Show. We always get great insights from you. We want to wish you all a very good rest of your day and a rest of the week. And Buff, thank you again. I'll let Debbie know that we saw you, and hopefully we'll have you back soon.
all right, thank you.
Thank you, Buff. Thank you,
All right.
everybody. Enjoy the rest of your day and week. Take care.